When do I start?
You talk to them.
Hello, I'm Michael Oliver with Momentum Structural Analysis. We're going to take a tour today through some archival charts of the stock market and current charts. And I've made these observations before in a Real Vision video several weeks ago, but we're going to add to it this time and give you some more information and perhaps some insights. You don't have to be a technician, I don't think, to appreciate the charts that have been provided to you by Real Vision. There's 5 sets of charts. We'll go through them one by one. And I'm just going to leisurely chat as we go through and make some comments and observations, and then we'll go to the next set of charts and so forth. But the conclusion we come up with after analyzing the stock market, which we've been doing since 1992 when MSA was founded, is that we have one of the darkest, most malevolent technical structures underneath the stock market that it's ever had before, going back a century of technical data. Whether we look at the Dow back in the 20s up through 1950, and then in 1953, I think the S&P began. But going through that entire period, we've never seen the technical vulnerability that we see now. MSA is unorthodox in its technical approach in that we tend not to focus primarily on price charts. We look instead primarily at momentum of price. And we measure momentum probably a bit differently than most people who use that term, which is a common technical term. Tools like MACD and RSI are momentum type tools, which really don't resemble the type of work we do. The question is, why do we distrust or place price chart technicals as a secondary to momentum technicals? And for explanation of that, we suggest you go to our website, olivermsa.com, and go to the method or methodology tab and read the articles and see the charts and the explanation as to why price to us is a secondary technical feature. To briefly give you an answer to that, a teasing answer is that price as measured by a fiat currency, let's say the bushel of price of corn, what's the bushel of corn cost in dollars? What is the given stock cost in dollars? What's the barrel of oil, et cetera? All measured in dollars or in euros or in yen. The problem is these fiat currencies, since 1959 anyway, the dollar has nearly doubled in quantity every decade. So if you consider that, let's say you had a yardstick and you were a builder building a house, and it took you 6 months to build the house, but your yardstick changed 1 inch every month. It still said 36 inches, but it really grew an inch, though it still said 36 inches. So by the time you're finished after 6 months of building, the house is likely to be in decrepit shape and collapse. So the means of measurement that we use in markets, whether it's the price of a stock or the earnings or whatever, is heavily distorted by the deterioration in the underlying fiat currency. And it's massive. It's not trivial. You can't look at CPI and back it out. Basically, since 1959, as I said, every decade is almost a doubling in the quantity of M2. So we think that's a distorted unit of measure, and therefore we try to back our way out of it to some extent. You can't totally get away from using the fiat currency as the first unit of measure. But what we do is we measure the market itself against its own means, its own averages, long-term on down to short-term. And to a large extent, the changes in the moving averages of that given market, while they are to some extent influenced again by the money unit of measure, they're more influenced by the movement in the underlying market. Whether it's a rapid up move or a gradual up move, it'll determine the rate of change in that moving average. So when we measure the market against its own means, we come up with a different type of chart, a momentum chart. And we look for structure. Just like most price chartists look at a price chart, they draw trend lines, floors, ceilings, so forth. And if they break, then it's a violation of the structure. And they make trend determinations based on these types of things. So if you'll go to the first set of charts we've provided, it's the Dow Jones Industrials monthly price chart at the top. from 1926 through 1929. And below the price action is overlaid a three-quarter moving average. Three-quarter moving average is roughly similar to a 200-day average, although the 200-day adjusts every day. The three-quarter only adjusts at the end of each quarter. But it's about the same duration of maturity of an average. It's pretty long term. As you can see in the price action from 1926 to 29, the price action went up in a curve form, more or less arching upward. And you would have 10, 15% pullbacks in route. Some of the drops look bigger later on in the trend. That's simply because the price had risen. And then prior to the actual top in the Dow, we had a congestion zone in early 1929, from which a lot of people were selling and distributing, getting out, obviously. But then it broke through that zone and spiked up into the August high of 1929. Now, if you look at the chart below, what that shows is the monthly bar price action of the Dow in relation to that three-quarter moving average. So, for instance, back in the early part of that chart in 1926, you were under the three-quarter moving average and you merged above it. And ever since that point in time, which would be the summer of 1926 through late 1929, the market lived above the three-quarter moving average and momentum lived above the zero line. They were both in sync, price and momentum, in terms of producing higher highs during the uptrend. You can see on both charts. But that changed in the summer of 29 when we spiked the price up through that congestion zone and shot it up to 380 on the Dow. Momentum didn't go back to the high. It made a demonstrably lower high, what's called a non-confirmation. Well, non-confirmations are interesting and they're often referenced by technicians. Some momentum indicator doesn't match a new price high. We give some credence to them, but they're generally what we call background features. They're not necessarily immediately actionable. They're just sort of a tap on the shoulder that something's not quite right in this given market. It's not confirming. Price strength is not being confirmed by the momentum of price. So after that period in August and in September of 29, the market rolled back over. Price action came down to the top end of the prior trading range of early 1929. And as soon as it sat on top of that old range, the momentum action dropped down to the three-quarter average for the fourth time in 3 years. In other words, the market had been living above the mean, returned to the mean 3 times comfortably. So it almost became habitual, and very comforting and reassuring that the market was going to stay on the positive end of that mean. And so no doubt after 3 years of this behavior, market participants were pretty happy with what they're seeing. But in early October 1929, the momentum action came down to that structure, the zero line structure, for the fourth time. And it did it from a non-confirmed high. And when it broke through in the early days of October, about mid-October of 29, it blew that structure out, and the whole event was over with in a matter of days. There was no time for committee meetings or debate. The market had spoken. It had given you the structure. If you were looking at momentum, of course, most people weren't at that time. They were looking at price. But momentum would have provided you with a clear picture of vulnerable structure pending below the market. Too much used over 3 years. So the fourth return to the mean did not return to the mean. It did what we call, it oscillated the mean. And it did so about as deeply below the mean as it had been above the mean. It had a swing move to the downside. Okay, now let's flip over to the next chart, which takes us to 1987, which happens to be a personal experience of mine. It was 5 years later that I founded MSA, based in part on impetus from what I learned in 87 and participated in. If you look at the price chart at the top, it looks similar to the 1926-29 Dow bull market. And momentum below was matching the upside performance in the price action. In other words, every time price make a new high, momentum would agree. So they were happy travelers. Problem was, again, in the summer of 1987, the market surged to a new high, came out of a congestion zone, just like in 1929, and surged as if a whole new leg was commencing. The new leg ended abruptly. You turn back down in September of 1987, and by early October, you again were hitting the zero line for the fourth time in 3.5 years. 3 returns to the mean. The 4th one didn't hold, and it was preceded by a non-confirmation. So you had tap on the shoulder, massive structure that was super clear. No such comparable structure existed on the price chart that you could look at and draw a line through 4 different lows or anything of the sort. It was an upward curving situation. So the price chart really didn't give you any hint that this down was going to be different than the other downs. Momentum did. And it was all over within days. And again, the swing to the downside in momentum was basically reflective of the high readings on momentum that had preceded the collapse. Okay, now we turn to the third set of charts, which is a bar chart format of the S&P 500 today, up to date, going back to 2009. And below it is a long-term momentum chart of the S&P 500, but plotted not against the 3-quarter average. This one's plotted against the 36-month average. So a much longer moving average, effectively a 3-year average. But we oscillate the momentum action against that. And ever since it emerged above the 36-month average, which occurred in 2010, in the early part of the recovery, the market lived above that 36-month average. It retreated to it 3 times. In the 2011 summer, fall 2011, we had the European debt crisis. At least the onset of it. We still have it. Stock market sold off, stopped at the 36-month average. The low monthly close was several percent above the 0 line. Then you started another leg up, lasted until 2014 and 15. Then we had that 2016 sell-off, dropped down to what? The 36-month average, wouldn't close a month below it, and then launched another up leg. The other up leg lasted to 2018, and you marginally non-confirmed in early 2018 on momentum versus the high readings we'd seen in 2015. It's a fairly marginal non-confirmation. And then you had a drop into mid-2018, rallied back up into the September period of 2018. Price there was making a new high, September of 2018 versus the January high of 2018. But momentum was non-confirming that event more grossly than had been the January high of 2018. The September high was markedly lower on momentum than was the January 2018 high. So you had a non-confirmation, it was clear. Then you had effectively the little mini crash, which MSA did call breaking down through 2,900, and we projected it was going to go below 2,400. And it did. It got down to the 36-month average again. And we defined a number for that December break. We said, if you touch this number, you're not even going to stop. Well, they stopped just in front of our number. It was like 23.17. Market stopped at 23.14. So basically, it held the 0 line again and produced yet another wave up. This wave up was grossly non-confirmed as well. This would be the highs we've made over the last 3 or 4 months. And now we're starting to roll over yet again from yet another marginal new high that didn't sustain. I don't know how many more marginal new highs you get before people finally give up on it. You know, it breaks out and doesn't go anywhere but down. Anyway, we're now looking at the structure pending below that's been used 3 times over a 10-year period. Good luck on the next trip down there. This is a much bigger structure than the 3 and 3.5 year quarterly momentum structures of the Dow in 29 and the S&P in 1987. What it says is that for a decade, investors have been placated by a market that only returns to its annual mean. It doesn't penetrate and collapse below. It holds around this annual mean and goes for another run. And so to some extent, what 3 years of comfort did to longs back in 29 and 87, we've had 10 years of that. So no wonder there's a lot of entrenched bulls out there who think it could go on forever. Well, again, there have been 3 hits on the 0 line. Don't do it a 4th time. Now we turn to the next set of charts, 4th set. These are available to you on the site. This is the same set of charts as were before, the bar chart version of S&P now and the bar chart of the momentum. This time it's only in the monthly closing version. So we plot each monthly close and price in relation to the 36-month average on the top chart. On the bottom chart, we plot each monthly close as a percent above or below the 0 line, the 36-month average. And of course, we've been living above the 0 line since 2010. The red line on the chart, slightly above, its horizontal line, slightly above the 0 line. And if you'll note, each of the low closing readings, monthly closes, 2011, 2016, and December of last year, halted at around 3% over the 36-month average. Perfect, within 0.5% each time. Never touching 2% over on a monthly close, but either side of 3%. So this oscillator shows the structure as being slightly above the zero line on a closing basis. And it's produced non-confirmations. And it's used that red line 3 times. So what we're arguing is this is a massive potential breakdown structure. We happen to think, and this is somewhat subjective on our part, it's based on experience. We don't think you better go down to even 2% over the 36-month average. Forget the zero line. We think if you go down to the red line on this momentum chart and drop below it, 2% over, that it's likely you don't want to wait for the monthly close for proving evidence at the end of the month. That month might be horrendous. So we see a pending structure here that is massive wide, has non-confirmed, has used the structure 3 times in a decade, and is now leaning and not far away from the structure. For this month, provided this number, that Real Vision video, late July, is 2631 S&P cash. We think if you even trade that number this month, you better have your helmets on or parachutes on or whatever you want. You know, if you're long, you better protect yourself. If you're short, it might be a place to add. But right now, we're very number-based. We want to see that number triggered, touched. That number will adjust up next month because the 36-month average is rising. The zero line is rising in price equivalency, such that next month, somewhere above 2650 will do the job. So we warn that all those people out there who think the market is deserving of a correction, they're probably right. But the problem is you can't correct. You do the math to get to 2631 or 2650 is not that big of a drop. It won't stop there. So a correction will not be a correction. It should morph rapidly into something far more dramatic. Now, another observation we've made recently, aside from these thoughts on this long-term momentum structure and the vulnerability, is that alternative asset categories are speaking. And some of them are speaking very loudly. A lot of people have noticed, for example, that the small caps, the IWM ETF of the Russell 2000, for example, is underperforming the stock market, the S&P 500. And it tends to, when you look at a spread of, we don't have a chart on this, but if you look at the performance of the IWM in relation to S&P, you'll see that in the up moves in the market over the last 10 years, generally the small caps will tend to outperform in those up moves. And when you get the down moves, IWM will underperform the S&P. The interesting thing is the IWM spread versus the S&P is just blown out. All its oscillator lows, its spread chart lows going back to 2008. So the small caps right now are speaking loudly that they don't trust the upside in the market for whatever reason. Now, the fundamentalists can provide those reasons, and you can yourself. But we take note of that. So alternative subcategory of stocks is speaking negatively about the general direction, the net direction of the S&P. So far, the S&P hasn't quite gotten the message, but sometimes it's one of the stupidest markets out there, I've said before, and I repeat it. Now, when you look over at 2 other major asset categories, Treasury bond futures, we look at the 30-year bonds, which are out of the reach of the Fed. So we like the T-bonds because they generally are moved by market forces, not by overnight rates in the Fed. T-bond futures turned up, we defined a turn up back in December at 141 on the T-bond future. And we thought it'd get up to maybe 160. It finally did. We're now in the mid 160s. But the interesting part of this, and this is the last set of charts, and they're just price charts here. If you look at that T-bond action, it went up gradually from late last year to 4 months ago. But then it started to go up at a steeper angle. In other words, it was no longer happy with an advance or the drop in yields. It wanted to go big time, rapidly. Why? What's the big story? Stock market's not collapsing yet. We understand that when the stock market breaks, often T-bonds will rally sharply. They did in 87, had a huge move. The question is, why are they doing it now? What are they anticipating? I think you can answer that question. We don't need to. But then you look at another one, it's gold. And despite the fact that the commodity asset category is still in a trading range and has been since 2016, roughly in a 20-point range on the Bloomberg Commodity Index, Oil's under pressure now, copper's under pressure, grains are back in their base. Everything's suppressed and capped off. So there's no real upside in the Bloomberg at the present time, though we think that's likely to change very soon. How come gold is advancing in line with the T-bonds? From last summer's low in gold, down at 1160, gold advanced through the end of the year, got up over 1200, then 13, and finally, a few months ago, broke out over its price shelf in the mid 1300s, which excited most price chartists. Momentum had long since said be long. And now gold's going up at an angle like this, much like the T-bond chart. You can almost lay the two charts on top of each other. Again, why? What's got gold so irritated? It's not commodity price inflation, at least yet. We think we're in a situation very similar to what occurred in the late 1970s. Gold turned up first from a bear market low. It had gone from $200 down to $103.50 in August of 1976, and turned up. And it took about a year later for the commodity category to join gold. But that's when the big bull market in gold and commodities occurred, 1977, 78 through 1980, while stocks floundered and were a no man's land, a wasteland for investors. But commodities took command. So that the liquidity provided by central banks, which is highly likely forthcoming, especially if the S&P drops anymore, the question is, will it go back into stocks like it did in 2009 when stocks were vastly oversold? Or will it this time go somewhere else, not especially where the central banks want it to go, namely commodity prices? That's our expectation. We think gold is already leading the way. But these two markets, T-bonds and gold, you should nail this chart to your trading room wall and perhaps put the S&P chart upside down, because we think these markets are speaking urgency. They're now in an accelerated mode, and I think they want to get to where they're going rapidly, and that hints to us that perhaps the stock market's going to do what it wants quickly. Now, I'm finished with my little talk there, and I no doubt some of you have questions, and I'll take a few questions. And I need to click on a certain button here. I don't see it.
Thanks for joining me.
I don't see a red button. End button. Oh, end stream. End stream?
Uh-huh.
Oh, okay. This is not yet. You sure you want to end stream? No, I don't want to end stream. No.
Well, if you don't, yes. Yes, click it.
Okay.